We are entering into another chapter in the second textbook, and in this next two chapters we will be learning about the financial aspects, or it is basically talking about the finance and finance related matters inside business. So we are entering into the ninth chapter, which is talking about financial management. Financial management is the name of the chapter. But before understanding financial management, we have to understand what is finance. Finance, as we all know that money is called finance, and when that money is required for some business activities, or when money is used for, when that finance is used for carrying out a certain business activity, we call it by the name business finance. And business finance is very important in business because it is a major part, it is a major thing which is deciding about the survival and the growth of business. So business finance is a very important aspect in business, and it is in this context we have to understand how it has to be managed, how it has to be used, how it can be used in such a better way that business goes to prosperity, business grows well, business exists. So in this chapter we will be learning about how we have to handle this business finance, what we are having or what we have raised, or from where we are getting, how we are going to use it. All these things we will be discussing. So basic thing you have to understand is business finance is that finance what is required for carrying out business activity. Now when we are having business finance, when we raise finance, when we take loans, or when we get it through shares, or anyway when we are having business finance, it's very important how we use it. So there we have to understand what is financial management. If you are looking at that word, you can see there is a word financial, second one management. The second word we are familiar with, management. It is making things happen through others, or through various functions, how things are made happen. We have already learned in the first textbook. So according to my concept, or putting it in simple words, we can say application of management, that is planning, organizing, directing, controlling of all this finance. Application of management into the area of finance, or application of management in use of business finance, can be called as financial management. But technically speaking, it is talking about financial management is talking about, basically it is talking about how we are managing, how we are handling, how we are using finance, how we are controlling finance. All these things are coming. But technically speaking, two things are expected out of financial management. When we are managing finance, two things we have to keep in mind. First one is optimal procurement, and the second one is usage. These two things are very important in business. So optimal procurement and usage. How we are able to use, how we are able to raise that, how we are able to raise finance. We are getting it from the better sources. From which all sources we are going to get it. Whether we are getting it at a better cost, at a lower cost, at an affordable cost, without much troubles. Are we able to procure finance? Whether we are able to raise finance from at a reasonable cost from available sources, from sources that are much benefitable for us. That is one thing. Second thing is usage of finance. How we are using this. How we are using this finance. Whether we are using this finance in such a way that it is giving the maximum return. Whether we are using it for, whether we have finance to use when it is required. So financial management is making sure when we are managing, when we are applying management in finance, it is making sure that there is optimal procurement. That means financial assets, finance is being raised at a reasonable cost from sources which are economical, sources which are easier. and we are using it in the proper way. And when we are using this financial management, we are aiming at reducing the cost. That is why I said financial management is concerned with raising finance. It can be from any source at a reasonable cost. Reasonable cost means what we have to pay for raising that. Maybe interest, maybe dividend, maybe bank interest, whatever be. So, on the basis, on the cost, how much cost we have to spend. So, it is aiming at, when we are raising funds from different sources, we are trying to get it at a nominal cost. When we are trying to get it at a reasonable cost. So, reducing the cost of funds procured. That is one aim. Another aim is keeping risk under control. There is chance of non-repayment. There is chance of non-repayment of funds. 11th standard you have learned about financial risk. That means that there is a chance of non-payment. So, those kinds of risk are to be avoided. So, making sure that when we are raising from certain sources, it can have risk. When it is required to be paid at a particular moment, we must be able to raise money for repaying it. So, many a times, if it is not possible, that is a riskier thing. If we are not getting return, it is a riskier thing. So, we have to keep the risk under control. And third one is effective deployment of funds. We are investing these funds which are raised into the most needy activities which can fetch us better return. So, when we are talking about optimal procurement and usage, this is what we are expecting out of it: reducing cost, keeping risk under control, and achieving effective deployment. These three things are to be kept in mind. And in simple words, we can say financial management is ensuring availability of funds required. In other words, we can say financial management ensure that the funds are available when it is required and avoids idle money. So, it is making sure that when a venture is coming, when an activity which requires finance is coming, enough finance is there with us to meet such a situation. And through that, what they are making sure is that no finance is kept unused. Finance is being applied in such a way, or finance is being used in such a way that it is fetching us better return. So, it ensures availability of enough fund required and avoid idle finance which is not fetching us any benefit. So, that is what is financial management. Once again, putting it in simple words, application of management into area of finance is called financial management, and it is concerned with optimal procurement and usage of funds, aims at reducing cost, keeping risk under control, and effective deployment of funds. Financial management ensures enough funds required at a time, availability of enough funds required, and avoid idle finance. Now, why we are doing all these things? Why we are raising it from sources which is of less cost? Why we are using it in the best possible manner? The simple answer is financial management is always concerned with, the objective of financial management is to increase shareholders' wealth. Increase shareholders' wealth. We call it wealth maximization concept. That means, in simple words, financial management, by raising it from economic sources, by raising it from less cost sources and using it in the most effective manner which provides us better return, what we are trying to do is to maximize the market value of shares, maximize the market value of equity shares, because equity shares are the ownership funds. So, increase the value of equity share or increase the value for owners, maximize the wealth of shareholders. This is the basic aim, or it is what we are trying to achieve through financial management. And for that, three major decisions are to be taken. By a finance manager to increase shareholders' wealth. And those decisions are termed as financial decisions. Financial decisions are decisions taken by a financial manager to ensure shareholders' wealth is increased or there is an increase in market value of shares. Those three decisions decide to a greater extent whether it adds on to the value of equity shares, and those three decisions are very important, or those three decisions give answer for the major issues which has to be handled by a financial manager, and the three major decisions to be taken by a finance manager. The financial decisions are investment decision, financing decision and dividend decision. Investment decision, financing decision and dividend decision. So these are called as financial decisions, decisions taken by manager in order to ensure there is increase in shareholders' wealth or increase in market value of equity share.